Good day, fellow investors. Yesterday we discussed Newmont, we added, now the question is, should we add Warner Bros. Discovery to our already large portfolio position? If you don't know, I have a YouTube demo portfolio, so 30 positions. The goal is to follow 30 stocks, learn about the thesis, understand the risk and reward, so you can see how it fits you. Lynch, after retiring, followed 50 stocks, did great over time, also since retiring. Goal here is to learn about the risk and reward, do good over the long term, learn and collect ideas. So educational disclaimer here. In that line, a month and something ago, we bought Warner Bros. Discovery WBD stock because it was a spin-off from AT&T, and all those AT&T dividend holders that now suddenly don't get the dividend there dumped it likely on the market. What am I going to do with this stock? And therefore it created an irrational situation on the market, and we bought it from that value investing spin-off irrationality perspective, with the upside that if they reach 8 billion on free cash flows, compare that to the 30 billion market capitalization, that is a price earnings ratio possibly of 3 or a 25-30% free cash flow yield. So if they reach their targets, that's it. If they don't reach their targets, if they reach just 6 billion and then a P ratio of 15, that's already 90 billion. So there is plenty of upside. And perhaps most important, this was pushed up, this small peak was pushed up by speculators expecting great earnings. Then earnings came in, those speculators got out. But if you look at the stock price, it actually didn't go down much. 10% before earnings speculation, 13%. So we might now be a bottom. Of course, it will depend on future news, but this might be the value investing bottom that one might be looking for. So not far from what we purchased it, and therefore very interesting to also follow the stock price connected to the fundamentals and learn more about the business and the investment. Of course, you can see past year 50% down as dividend investors dumped it. So we have bought 2,150 stocks. The price we paid was $13.71, and now the price is $12.70, so not even 10% loss on that position. There was a peak here, but if things, let's say, unlock the value over time and the management reaches, we can make much more money. Even Seth Klarman went in for the spin-off play, Warner Bros. Discovery, 3% of his stock market portfolio. So no other investment gurus bought it, so it will be interesting to follow. Now let's start with the earnings and a big lesson to learn from an investing perspective that I honestly forgot before the earnings call. And that lesson is that whenever there is something new, a merger, a spin-off or something or whatever, I don't know the correct phrase, let me know in the comments, but it is that the management will kitchen sink everything. So they will throw everything that's bad, the Batgirl movie that doesn't fit with them, oh, we don't want to be connected, let's trash it. They will dump everything, impair everything. So the first earnings will usually be the worst earnings. And the earnings were actually a disaster compared to expectations, but the stock price didn't move that much. So they will clean all the bad to get a fresh start. And let's really look at that fresh start, Q2 2022 earnings. This is from Q1. And the CEO said what they were doing. I could not be more excited about the massive opportunity ahead. And then we got to reality after just one quarter. So, okay, stability, revenues were there, stable, no growth, no big decline. There was a big loss of 3.5 billion, but amortization of intangibles, the movies, restructuring and other charges, and transaction and integration expenses. So 1 billion, 2 billion that goes to Wall Street, as we discussed in the margin of safety. Wall Street works against you, chapter 2. So EBITDA was there, maybe a little bit lower than expected, but still cash provided by operating activities was there, 1 billion, and cash flow 789 billion. Huge debt, 53 billion, so that is high. They want to lower the debt and the net leverage, but they want to do it by increasing EBITDA. And if you look at the numbers, cash flow is there, the assets are there, but look at the characteristic of the assets. Goodwill and intangible assets, the movies, of course, are the core value there. So that is, again, an assumption. How much is this valued? That we'll see in the future, but they go on and on about the great content they have. And I'm happy to see here George Carlin also of enough quality to be on HBO and to be presented in the Warner Bros. Q2 presentation. Very interesting. They want to expand globally, increase the markets, break even on streaming in the US, and then also slowly, healthily increase average revenue per user. I think they will be able to do it. I'm just looking, we are paying for Netflix, and now it's time to do something else. So maybe next year we'll switch to this if it comes to our country, or Disney is coming. So there will always be this churn rate, something this, you get fed up, you go for something else. So very interesting how that will work, but I think the whole population of these streamers and everything will likely grow, which is a positive structural trend. Plus, don't forget, they also have much other with linear TV and everything that other streamers don't have. So content is there, networks, direct-to-consumer, studios, etc., etc. They have shown stability. There are some issues, some things do better. They want to capture more of the synergies as they go on forward over the coming years. We'll see how that works. The debt is still there. Okay, fixed, mostly fixed. Average cost of debt 4.3%, nothing bad. If I listen to the conference call, they have now management in place, is what they say. They glorify the content. They are not just a streaming strategy as others, and their goal is to increase average revenue per user. If you don't want to listen to those webcasts, you can always check on Seeking Alpha. You have the transcripts of all of the conference calls from most companies, which is very, very convenient. If you want a 60% discount or something like that for Seeking Alpha Premium, you can click on the link in my description of this video below. A lot of content. If you're a researcher, it's hard to avoid it. And now here we come to the bed of this conference call. We are starting from a less favorable position compared to our expectations. They trashed some movies, Scoob, Batgirl, Wonder Twins, and people hate changes. So when you change something, people hate it, and it's normal. That's the uncertainty that it brings. But here is the hard part of it. So they are adjusting the outlook because of less favorable macroeconomic backdrop. I think that television doesn't have to be that impacted by macroeconomic if you do quality, but they do it, and that's something I don't like. Also comparing Summer Olympic Games, NBA, in Easter conferences, etc., etc. They're already saying that Q2 will be bad. So I'm saying, okay, I'll wait with the next purchase. I'm still already good exposed. But if Q3 is bad, then I'll wait a little bit more, maybe with the market crash. We still have time to add the money that is left. And they expect to generate free cash flow 3 billion in 2022. Okay, outlook based on synergies, on growth, EBITDA of 12 billion. They want to hit. If they don't hit it, it will look very, very badly. Balance sheet is there, a snapshot. Fixed, as we already mentioned. And then let's go to the Q&A, which is always very interesting because you actually hear what the analysts are focused on and how the management deals with those questions. So, Batgirl question, of course, losses on US linear networks, and then they say that sometimes you lose, sometimes you win, sometimes it's stable. So they also don't know how will linear networks work, but they are very positive about those going forward. And then the main reason, macroeconomic environment. I hate it when management has plans and then changes them because of the macroeconomic environment. They give no guidance. They hope to reach 15 billion of EBITDA somewhere, and that's 7 billion per year. But let's say they don't reach it, they reach 12 billion, just 40% cash conversion, that's 5 billion in free cash flow. They will use to lower debt and everything, but still 5 billion compared to 30 billion market cap is still a free cash flow yield of 16%. So still, even in, let's say, not such a rosy scenario, this could be a 2x when the cash flow yield goes to 8%. So the thesis is still there, value investment based on dividend holders selling the spin-off, likely oversold if positive news, easy double over the next couple of years. If not, somebody might take it over for the content and everything. Short term, expect volatility. They have high goals. We'll see how they will develop on that. The stock didn't fall much, thus might be bottoming out. Thanks for watching. Smash that like button, check my other videos, and I'll see you in the next video.